For the first time in 40 years, the American economy is breaking its own rules. Inflation isn't steady, it's stubborn. Markets aren't leading policy, policy is steering the market. We've seen this before. We've seen it in 1972, the median US house cost about $22,000. Just 10 years later, it was around $66,000. Oil went from $3 a barrel to $38 a barrel. If you held around $1,000 in cash in 1972, it would buy you only $400 worth of goods just 10 years later. In the early 70s and early 80s, they witnessed a decade of runaway inflation that changed how Americans worked, saved, and invested.
People who want to work but can't find jobs are part of today's other bad economic news. The unemployment rate soared to 8.2% nationwide last month, and it rose to an even higher figure here in California. A statewide jobless rate of 9.3% has jammed local unemployment offices. In terms of people, some 920,000 Californians are now out of work.
Just 50 years later, economists are now warning that we're re-entering another transformation, a new era of American economics, an era where government power and not the free markets defines the game. To understand where we are, we have to understand how to see the world. Darius Dale, the CEO from 42 Macro, uses a system I like. This system is called the grid model. It's a simple framework that maps out every single macro backdrop by the direction of growth and inflation. So 42 Macro has 4 different theses on how to invest during the times ahead in America. The grid model stands for Goldilocks, reflation, inflation, and deflation. Goldilocks and reflation are risk-on market sentiments. Inflation and deflation are risk-off market sentiments. There's 12 factors that are included in the grid framework. However, for the focus of this video, we're going to focus on 5. The first being general bias of the market. The second being the style of asset. The third being the market cap of the assets. The fourth being which commodities are at play. And the fifth being the dominant currencies in the markets. For the risk-on sentiments like Goldilocks and reflation, the general bias in the market is towards risk assets. Risk assets like AI stocks, Bitcoin, crypto. Think of things like that when we're talking about risk assets. In terms of the style, it leans towards growth stocks rather than value stocks. So think of those high performers rather than dividend-based stocks. And to get even more technical, in regards to the market cap, we're going to take a look at small to mid-cap offerings. These are companies that are potentially in the Russell 2000, anything that isn't a large cap asset. This is the area where you're going to find majority of the best performers. In terms of commodities in the risk-on sentiment, we're going to be taking a look at industrial commodities. Energy commodities are going to be all right, and agricultural commodities are typically going to perform the worst. In this type of environment, you're going to see gold perform really well, and foreign currencies in the US dollar is going to perform slightly worse. In a risk-off market sentiment, everything is flipped. The general bias is towards defensive assets rather than these riskier assets. The style specifically for inflation leans towards value-based assets rather than growth assets. In a deflationary market sentiment, it's kind of the opposite. The growth stocks are going to recover the best and the value stocks are going to be slight underperformers. However, what remains the same in the market cap and the risk off sentiment is that now you want to target large cap offering rather than the small and mid caps. In terms of commodities, this is the time where agriculture commodities are going to typically perform the best and energy and industrial commodities tend to fizzle out. In regards to the currencies, however, in the inflationary market, the US dollar tends to perform well, gold perform really well, and other foreign currencies aren't as strong. So you're probably asking, why does this even matter? This is because each quadrant demands a different playbook on how to invest. Right now in 2025, the US sits close to the inflation quadrant where growth is slowing and prices remain sticky. But the bigger story isn't this quarter's data. It's the structure of the economy shifting beneath it. The team over at 42 Macro calls this transition Paradigm C. It's the third major policy era since 2020. These are essentially models or systems on how the government makes its policy decisions, especially the monetary ones. Paradigm A was the pandemic response. It was massive stimulus packages that caused record inflation. Paradigm B was a correction. Rate hikes, tighter spending, supply chain healing. These are some of the things we saw during that time. Paradigm C is the new normal. This represents the permanent state of big government spending and central bank accommodation to support growth at any cost, sacrificing the future for right now. This is what economists call fiscal dominance, when government spending and not monetary restraint becomes the main driver of growth. The US Treasury issues more debt, and the Federal Reserve enables it directly by keeping rates artificially low. Markets rise not because business earnings are improving, but because liquidity is flowing into the system. We currently have models from the Congressional Budget Office and Penn Wharton that predict that the US federal debt will surpass 120% of GDP within the next decade. The government can't cut their way out of this. It has to inflate its way out. That's why 42 Macro calls this fiscal dominance 2.0. It's not just stimulus, it's a structural shift. This moment that we're in is part of a much longer cycle, something historians call the fourth turning. Neil Howe and William Strauss came up with a brilliant theory on how economic and political cycles boom and bust throughout history. It all has to do with this.
Like nature's four seasons, the cycles of history follow a natural rhythm or pattern. Over the last 5 centuries, Anglo-American society has entered a new era, a new turning, every 2 decades or so. At the start of each turning, people change how they feel about themselves, the culture, the nation, and the future. Turnings come in cycles of 4. Each cycle spans the length of a long human life, roughly 80 to 100 years, or the unit of time the ancients called the saeculum.
Approximately every 80 to 100 years, societies face a reset. Institutions lose trust, systems break down, and new economic orders emerge. The last fourth turning included the Great Depression and World War II. Regardless of the era, every time a fourth turning happened, governments ran massive deficits and inflation surged as currencies weakened. Paradigm C is the thesis on how to invest during an era of volatility, rising debt, and state-driven capitalism. The system that powered the post-war boom is reaching its end, and a new one fueled by fiscal expansion is taking shape. Well, what about right now? Even with aggressive interest rate hikes in previous years, inflation refuses to die. Using 42 Macro's secular inflation model, this pegs the new normal of inflation around 2.8 to 3%, which is higher than the Fed's 2% target. So why is inflation so sticky? Well, it's simply because fiscal policy is still expansionary, meaning that the government is still continuing to use tools like increasing spending, tariffs, and reshoring of businesses raise production costs. The labor markets remain tight as minimal jobs are being created. Not to mention that immigration to the US is slowing down. And credit is still easy enough to get that it can fuel demand into other assets, like the stock market, like real estate. You see, it may not seem like a crisis now, but all this is a quiet tax on purchasing power. Oddly enough, the economy hasn't collapsed yet. This is despite households not having the leftover pandemic savings that they built up in the past. Corporations are also locked into cheap debt that they acquired years ago. Instead of a hard landing, we're seeing rolling slowdowns of the economy. One minute it's manufacturing here, the next day it might be housing there. There's small cracks showing up everywhere.
And food, I'm showing up to food banks when I can. We're applying to jobs constantly. Our unemployment just ran out, so now we have no income coming in.
But no collapse yet. The Fed calls it a soft landing. The reality is, Jerome Powell just wants a soft landing. But guess what? Wishes aren't always reality. And with the cracks widening, it just seems that they're delaying the inevitable. With growth of the broader economy being mid at best and inflation remaining stable, the data shows that we're in the Goldilocks regime, the sweet spot for risk assets. Right now, equities, commodities, and crypto tend to outperform everything else. The dollar weakens, defensive assets underperform. Keep in mind that this phase never lasts forever. Once again, it's been your boy Ako. Hopefully you get it, you got it, you're good, you learned something, and I'll talk to you in the next one.